law changes? Nobody's aware of the new tax law changes? So do I need to do a little recap of the tax law changes before we jump in? Okay, so let's do a recap. So we know that last year the president signed into law a new tax bill. Some of it went into effect as of December 15, 2017, the mortgage component of it, where if you have a mortgage that is new as of 12/15/2017, and if that mortgage balance is over $750,000 on your primary residence, not rental property, your primary residence, you're only going to be able to deduct the interest associated with the mortgage that is $750,000 and below. Some of you may be sitting on $1 million mortgages. Some of you may be sitting on higher than that. Realize that the interest only on the piece, if you have a brand new mortgage, brand new, you're already grandfathered if you had a mortgage prior to 12/15. You're only going to be able to deduct the interest on the first $750,000. That's going to be really important because your 1098 mortgage interest statement is going to give the full interest. It is going to be up to your tax professional to make sure that they break that interest down and allocate it properly. That's one thing that has changed. Something else that has changed in the law that really boggles my mind is you used to be able to take an exemption deduction for yourself, your spouse, and your children on your tax return. And that amount was $4,050. So if you can imagine, a family of 4 would be able to take a deduction of $16,200. That deduction is gone. So you will no longer get an exemption deduction for yourselves or your children on your tax return. That's a huge difference. And I just saw the puzzled eyes where you guys are like, what? I know. It will not happen. So the question becomes, do you still put your kids on your tax return as dependents? What do you guys think?
Yes.
Who said yes? Okay, why do you think that?
They still have the child tax credit.
Okay, very good. You're right. So there's still the child tax credit. If your kids are 17 and below, you'll still get the child tax credit. They added a new dependent credit. Like if you're taking care of your elderly parents, there's a $500 dependent credit now. But where I feel like there's going to be an issue is some of us have kids that work like little part-time jobs, W-2 jobs. So we may be thinking in our minds, you know what, well, we might as well not even put them on our tax return since we're not going to get the exemption deduction. Maybe they no longer qualify for the child tax credit because they're just right at that age where they sort of think they know everything. They think they can take care of themselves, but not so really, right? How many of you guys had kids like that, right? All of you. So the key is, though, you probably still want to keep those kids on your tax return because they're your dependents for medical purposes, right? To qualify for medical insurance. When it comes time, if you have children where you need to do college applications, other things like that, you got to be real careful letting your kids go off, file their own tax returns, and do their own thing. It will be interesting to see how that's going to be handled. So my thought would be your kid will still file their own tax return with their own W-2, but there should be a box that says, I will be carried by someone else, even though there's not an exemption deduction. I haven't seen the 2018 tax forms. I don't even know if they're out. Bill, have you seen those?
No.
They're not even out yet. So I don't even know what that's going to look like. But I just want you to be aware of that. Don't allow your kids to kind of go rogue on their own because there may be repercussions on the back end. Are you guys following me? All right, so that's something that is going to be a huge difference. So I'm going to say to you, if you're married and you have children on your tax return, you are losing out on a big chunk. What are you going to do to make up for that deduction? And if you have kids that are 17 and above, you're not getting a child tax credit. And some of you may not get it anyway because there could be a potential income limit. We had a question.
Can you do your brother, sister who is living with you as a dependently in the new law?
Under other dependents, depending on how much money they're making, depending on if you're taking care of them more than 50% of their living expenses. So it's a whole thing. So the answer is possibly something we need to analyze and look at. I don't want to say 100% for sure because Karla's spilling her water on her cell phone right now and she needs some napkins. I don't want to say 100% for sure, so I don't know the answer to that definitively, but it's possible to carry them.
Yeah.
If you're
in the past, then you can deduct if you have more than 50% carry.
Yep.
Therefore.
But the only reason why you would be deducting them now would be because you would be getting a $500 credit for them. That would be the only reason you would take them now in the return. Or maybe you're paying some medical expenses or something of that nature. So that's something that we would really need to analyze and look into because you're no longer going to get that $4,050
Right.
per person.
Oh.
Okay? So you guys all clear on that piece? Yes.
My son, he has a full-time job, but he's going to school.
When you say full-time job, I understand, but in our tax world, we look at like dollar amount as to whether or not you can really kind of claim that dependent. He could have a full-time job and be making $4,000 a year, you know what I mean? Like it just kind of depends on his income level as to whether or not he should still sit on your tax return.
It all depends how much he makes.
It all depends on how much he makes. Do you need him on your return for medical benefits? Like, yeah, so see, he may still need to write on your return, but he files his own return, but he just doesn't claim himself.
Okay.
You follow me?
Okay.
All right? So don't just think because you have a full-time, you have a kid who's working full-time, that he's 100% on your return. We need to look at dollar threshold. We need to look at medical issues. There's a lot of other things we need to look at before we just make that hardcore decision.
Because he makes okay money.
Yeah, so chances are probably he's on his own. But where are we on the medical side of the equation?
He's on everything.
Okay, so do you have one of those employers that requires them to actually be physically on your return as a dependent?
I don't know.
Yeah, probably not. He'll probably be okay.
Okay.
But he will definitely need that form to show that he has medical coverage, right? You're probably going to get that form from your employer,
Yes, I do get
that 1095. So he's going to need that to show that,
Oh,
okay? All right, so you guys understand that piece of it?
Yes.
So your kids are no longer as valuable as they used to be. They diminished in value overnight. Sorry. Right? Rent just went up. Those kids got to pay more money now.
It's still dishes.
Right? There's still dishes and trash got to be taken out.
You said there's a benefit being married, right?
Is there a benefit being married? Depends on which day you want to ask me that question. I'm not real sure. The benefit of being married would be for tax purposes. Why are you laughing? For tax purposes, it would be married filing joint, right? So it depends on really where your income is, whether it's a true benefit or not. It could be a detriment. I don't know. You know what I mean?
Okay.
But typically, married filing joint, you should be in a lower tax bracket, typically. But it depends on how much you guys are making. Like, there's a whole calculation that goes into that. You could be losing out on deductions, you know? You could be, there's a lot of reasons why you may not want to be married filing joint. I don't know. Something we need to look at. Okay. All right. And I'm not against marriage, man. I'm married. I've been married 28 years. I'm just saying. I don't know if that's a good thing. All right. Let's keep going, guys. You guys are funny. All right. The second trap, the 20% business income deduction flow through. Are you guys familiar with that?
No.
All right. So if you have a business that's a flow through businesses are businesses like a Schedule C that sits inside of your personal income tax return where you operate as a sole proprietorship. Typically, a life insurance agent, a real estate agent, they're typically going to file a Schedule C inside their personal income tax return. Or you could potentially be a single member LLC or a multi-member LLC where you're getting a K-1 form that is going to flow through to your personal income tax return. A partnership return is going to be like that. So now they came out with this new law that says, okay, if you have a flow-through entity, a flow-through business, we're going to give you a 20% business income deduction. 20%. So you may be thinking, okay, Karla, well, if I make $100,000, does that mean I'm going to get a $20,000 deduction? Do you guys think that's the way it is? Of course not. There's always a catch. So there's definitely a catch to it. I decided I was going to print out and just give you guys a little bit of a visual. There is a loan calculation as to how that is going to be calculated. and I printed out 7 pages for anybody that wants to do the math on it as to how the calculation goes. It's very complicated, but there's a couple of things that I want to tell you to make sure that you qualify to get that 20% deduction, because it's out there and it's available, but there's a couple of hoops that we need to jump through. So number one is that it's not just a flat 20% off the top of your income. That's the first thing I want you guys to recognize. That's not the way it's going to happen. There is a complicated calculation that is involved. Okay, there's a calculation involved, and it's pretty in-depth. One of the things that you also need to know, that if you are sitting in an S corporation, for example, and you don't have any other assets sitting in that S corporation, you're going to need to be on payroll, pull a W-2 out of that S corporation in order to get that 20% deduction. So a lot of you may not be on payroll through your S corporations. It's a flow-through entity, but the calculation is going to require there to be W-2 wages. And if you're sitting in that S corp by yourself, you're not going to have W-2 wages unless you put yourselves on payroll. So just be aware of that. This is not going to be an automatic deduction for you. And a lot of you may be thinking that, oh, I'm going to get 20% off. You will not get 20% off. So we need to really figure it out, strategically set it up so that you can get the 20% off. Is it doable? Yes, but there's a few hoops that we need to jump through. Does that make sense for you guys? Yes.
So, if the W-2 income could be from another company, does it have to be?
No. If you are an S corp, the W-2 income, when we do that calculation, the W-2 income needs to be in your S corp. Now, to answer your question a little bit further, if you have W-2 wages from another job, because you might, we're going to look at that too, but that's for a different part of the calculation. Okay? Are you guys with me on that? Are you sure? Yes.
It doesn't include the Schedule C, just the S-Corp LLC.
It does include Schedule C. It does include LLC. It does include S corp. But let me tell you why specifically you have to have W-2 wages coming out of an S corp. Because when you're on a Schedule C, when you are an LLC, when you are a partnership and you have net profit, those entities and the profit from them are subject to self-employment tax, that 15.3%. So you're already paying that self-employment tax. So the wage requirement is not there. On an S corp, unless you put yourself on payroll, that income is flowing through you passive. It's not getting hit with self-employment tax. So there's a requirement that you put yourself on payroll. Okay? I know it's complicated, but I just want to bring the level of awareness up so that you guys know we need to take actions. Does that make sense? All right, yes.
No, this employment tax is about the state or federal?
Is the what?
Is it state or federal, the payroll tax?
The payroll taxes, okay, that's an interesting question. So when I say self-employment tax, I'm typically talking about Social Security and Medicare tax only when I talk about self-employment tax, okay? But if you have profit, you're going to pay state and federal income tax. Possibly you can have that withheld from your paycheck. There's no requirement that you have to have federal and state income tax withheld from your paycheck. You could exempt yourself out on a W-4 and you can say, I don't want any federal or state income tax, but you will have to pay Social Security and Medicare tax if you're on payroll. But at the end of the day, what's going to happen come April 2019, you're going to be responsible for the income tax, the Social Security and the Medicare tax. So we want to make sure that if you put yourself on payroll, that you're not technically going to owe any additional tax. So there needs to be a calculation done. Are you guys following me a little bit on that? Everybody looking at me like, no, so let me back up. How many of you guys work for an employer and have a W-2? Some of you? How many of you guys used to work for an employer and had a W-2 at some point in your life? You guys never worked for an employer and had a W-2? Never got paid? Right? Okay. So let's say when you guys work for an employer and you guys get a W-2, you get your paycheck, right? You get your paycheck every 2 weeks. Let's say, for example, for simplicity's sake, you make $1,000 a week. Do you get that full $1,000 a week?
No.
No, right? What comes out of your check is your payroll tax. So you're paying Social Security, you're paying Medicare tax. It's being withheld out of your check, and your employer is remitting it to the appropriate agency. What you probably don't see is that your employer pays the other half of your Social Security and Medicare tax. The amount runs about 15.3%. You're only paying about 7.65 of it. Okay, so your employer pays the other piece. When you are self-employed, you are your own employer when you're self-employed. If you're sitting as a sole proprietor, an LLC, or a partnership, you're going to pay 100% of it. Okay, you with me? Regardless whether you do it and pay it quarterly through estimated taxes, whether you put yourself on payroll and pay it, come April, you better pay it. You know what I mean? Like, it's due. Regardless of the method, it has to be paid. That's what I wanted to explain to you. So to answer your question, you only have to be concerned about actual payroll, Social Security, Medicare tax, unemployment, food, all the other payroll taxes that come out. All right? Okay. All right, so you guys follow that piece? So realize if you have a business, the takeaway is if you have a business, you want to make sure that we walk through that calculation so you can get the benefit of that 20% deduction. Did you have a question in the back?
I did. Aren't corporations due March 15th?
Corporations are now due April 15th. Oh. If you are a C Corp.
I am.
Okay, that's April 15th now. That changed.
Okay, and then, and this is not 20% deduction off the top doesn't apply to C Corp.
That's correct.
Okay.
All right. Okay, the other thing that we need to look at is SALT. SALT stands for state and local tax. There is now a limit on the amount of state and local tax that you can deduct on your tax return on Schedule A. So if you itemize deductions, chances are you are deducting your state income tax withheld from your paycheck, your property tax, and your DMV fees. Are you guys following me on that? Right? And in the state of California, unless you bought your house 100 years ago, your property taxes are probably pretty high. If you have property tax and state income tax, you're now limited to only deducting $10,000. So if your property taxes are $17,000, if your property taxes are $9,000, you're only getting $1,000 of state income tax. There's a limit now on that amount. You guys are shaking your head. It's a limit. All right? Now, do I think that's fair? Of course not. I didn't write these laws. If you guys vote for me when I get ready to run for president, I'll get this straightened out. But here's the thing. There's a limit. So now you have a decision to make. Because if you are deducting your state income tax and you happen to get a refund, and I hope you don't get refunds because I don't believe in refunds. That's another story. I hope no one in here is getting refunds. Don't look at me puzzled. I'm going to tell you why in a minute. Okay. When you deduct your state income tax and you itemize your deductions, what do you get in the mail the following year? You get that little postcard, that little 1099-G postcard that says your state refund was $200, $3,800. What do you have to do with that little postcard? You do what with it? It's income the following year. It becomes income the following year on your federal income tax return. So if you have to make a choice between deducting your property tax and your state income tax, and you are to hit the max, you want to deduct your property taxes. Are you guys following me? You would deduct the property taxes, not the state income taxes, because the state income taxes become taxable the next year if you're in a refund situation. So it's starting to get very convoluted and complicated. So you really are going to have to strategically think about your taxes this year. It's not going to be business as usual. When this tax law came out, they were talking about the average taxpayer should be able to do their tax return on a postcard. And I'm still trying to figure that out because I'm baffled. Like, I printed out the calculation. You follow me? There's a lot to it. So I don't see how that's going to happen. What was that?
Postcard workbook.
Yeah, postcard or workbook. It's going to be a workbook now, and it's going to come with a 10-key machine. That's what's going to happen, because it's getting very complicated now. You have to start to think about what you're really doing. So make certain that you deduct the property taxes first and then the state income taxes next, if you don't hit the threshold. I think my philosophy is going to be, and this is something I'll discuss with my team, but I don't even know why we would want the state income tax even on the return if it's not deductible. I can see some major confusion in that. So I don't know that I would even put it on the return. I think if the client is maxed out with the property taxes, we leave it. So it'll be interesting to see what happens, but be careful, because you can be turning yourself into some taxable income. Yes?
What, with the $10,000, if you have multiple properties, is it still $10,000?
That's a great question. So this $10,000 pertains to Schedule A on your personal income tax return. So if you're multiple properties, and I know where you're going, you're probably thinking vacation home type of thing, you're maxed out at 10 grand. That's why you don't want to have multiple properties. If you have multiple properties, we need to look at converting something over to an investment property, a rental property. It's not going to behoove you to have that vacation home sitting on Schedule A like that. And I have the vision of what you're talking about, so we need to make an adjustment there. Yep. You guys look scared. Don't be scared. We'll get it all figured out. It's okay. I told you I have my whole team in the back of the room. We got you. Don't worry. We'll get it all figured out by the time tax time comes. You know, I would imagine that the tax forms are going to come out a little bit late this year. You know, they're going to be late. There's going to be revisions. It's going to be a mess, but this is the business we signed up for. It's going to be okay. Take a deep breath. All right. Trap number 5, meals and entertainment deductions. How many of you guys in here own your own business? Okay. So if you own your own business, realize that entertainment is no longer deductible. There's no more entertainment. There's no more parties. IRS said there's too much playing going on in this world. So no more of that. Okay? So meals can still be deductible. Right? Gotta eat. It's like, woo. So meals can still be deductible. But I am going to tell you as we move forward how you need to deduct those meals. Because anytime that IRS starts to crack down on stuff, you can best believe they're going to start to audit those things. So we got to be very careful as to how we deduct meals. And at KDA, we're going to be very, very hardcore with asking you guys for the appropriate documentation. That's going to be very important. So if you're still taking your clients out for meals, that's still tax deductible. But you're supposed to, and this has always been the law, IRS hasn't enforced it as much, but when you take a client out for a meal, do you know what's required in order to get that meal deducted?
Have their name on the back of the receipt and the date and who you took out.
I like you. Have the name, the date, and who you took out on the back of the receipt, and why it was a business luncheon or meal. Put it on the back of the receipt. Technically, you're supposed to have a journal of your meals, travel, entertainment. But if you just keep it and write it on the back of the receipt and then keep the receipt, don't throw the receipt away, keep the receipt, right? Then you could flip the receipt over and you could justify it. But you have to have the reason why it was for business, the date and time, and what you talked about. And technically, you're supposed to talk about business before you eat. Now, how IRS is going to regulate that, I don't know, but that's just the letter of the law. They said talk business before you eat. I don't know about you, but I'm going to eat, then I'm going to talk business, right? Let's just keep this real straight. But that's truly the letter of the law, all right? All right, so you guys with me on that?
Question, is it just the person's meal or the entire meal? Is there no alcohol?
There's nowhere in the tax code, because I would have found that girl. There's nowhere in the tax code that says that alcohol is not tax deductible. I have never seen that.
Well, I know some companies, it's like they don't want it.
Oh, that may be a company rule, but that's not a tax code rule that I know. A bill is have you seen that anywhere? I haven't seen that anywhere in tax code.
I think it's more of a company.
Yeah, that might be more of a company rule. Yes.
And is the maximum for groups that we can deduct?
I'm sorry, I didn't hear your question.
The maximum, the amount that needs to be paid for.
The maximum.
Maximum amount per meal.
There's not necessarily a maximum amount per meal. So meals are 50% deductible, but probably what you're thinking about is that $75 per day per diem. You may be thinking about that amount. There's no maximum amount per meal, but it obviously needs to be reasonable. So it depends on what's considered reasonable. I love this stuff when IRS has in a code reasonable basis. What's reasonable, right? Who decides what's reasonable? Carlton, stop asking the questions. who decides what's reasonable? The taxpayers decide what's reasonable, right? Are you going to let the IRS decide what's reasonable for you? If you do, you're in trouble. You got to decide what's reasonable, right? All right. So when it comes to the meals and entertainment, you really got to watch the categorization of the expense. When your tax return goes in and you're writing down the different expense categories, be careful, because you got to remember the person looking at that tax return, if they think it's entertainment, what do you think is going to happen? You're going to get an audit letter, right? So you got to be real clear. I would lead everything with business, right? Business meeting, whatever it is. But be careful of using words that look like entertainment. That's the one thing that I can tell you. Be very careful of your categorization. The next thing I want to talk to you about is owing IRS or getting refunds. How many of you guys think you should be getting refunds from IRS? One person? I'm going to talk to the two of you after this. How many of you think you should owe IRS? One person think they should owe IRS. Okay. Let me tell you what my philosophy is, and let me tell you what IRS wants. IRS does not want you getting refunds, and IRS does not want you to owe them. They really want you to be at break even. So this is the first time in the history that I've been doing tax returns, which has only been 20 years, that IRS actually put out a bulletin on this. If you go to irs.gov, you will find the bulletin. The bulletin states that the General Accounting Office has stated that millions of Americans are going to owe tax. IRS is now in a panic, and they have created a paycheck tax calculator on their website. They want taxpayers to go in, put in all of their information, do a paycheck checkup to see if you're going to owe. And if you're going to owe, they want you to change your withholdings right now or increase your estimated tax payments. So that's a bulletin that's put out. If you Google it, it's all over the news. And that came as a result of a study that the General Accounting Office did based on this new tax law. The new tax law came out saying that taxpayers were going to pay less tax. But when the GOA did the study, it came to, no, they're not going to pay less tax. They're going to owe more money. So now we got a problem, right? Most taxpayers are probably going to get sticker shocked come April 15th. And the questions are going to become, if you owe tax on April 15th, are you going to be penalized? Who say yeah? Yeah, you're going to be penalized. Regardless of whether you understood the law, didn't understand the law, it is your requirement to make sure that you do understand it and that you do pay in the correct amount of tax. And technically, the tax is really due January 15th. Not April 15th. It's really due January 15th, to be quite honest. And a lot of people don't understand that. So I am estimating that a lot of taxpayers this year, just basic people, are going to owe. And then what's going to happen once you start to owe IRS? Does anybody know? What happens when you owe Uncle Sam? What'd you say? They're going to charge you interest. They're going to charge you penalties. Your name going to go in the collections department of IRS. They're going to have your number. You probably going to get a certified letter. We had a client the other day, just 2 weeks ago, emailed to our office the note that the IRS left on his door. Oh, yeah. Oh, shocking, right? They have what's called revenue agents that audit, and they have revenue officers that collect. the revenue officer came and knocked on his door. And he wasn't home, so they left a note that said, contact me. You never want to get into a collection situation with the IRS. Just really try to avoid that. So does anybody know what my philosophy is?
Right.
When it comes to IRS and paying tax? No? Who said it?
You said run, I said Ecuador.
You said run? You can't run from the IRS. They're watching you, right? I believe that you should pay your fair share of tax, but do not leave Uncle Sam a tip. I believe that you should understand the law or get to somebody that does understand the law, but I do not believe that you should get a refund, and I do not believe that you should owe Uncle Sam a check on April 15th. So this is my philosophy. I don't want the IRS to know my name. I don't know about you guys, but unless you guys want the IRS to be your friend, then let me tell you how you avoid that, right? Rule number 1, don't owe them. Don't give them an excuse to send you a letter. If you know you're going to owe tax, we need to be paying those estimated taxes, and we need to be paying it on time. We don't want to get into a slinky with the government. That's the first thing, because once you get behind on tax, it's very difficult to catch up. Extremely difficult. It's like a snowball effect. So we don't want that to happen. So how do we avoid getting ourselves in that situation? Does anybody know? I'll wait.
Hire Karla Dennis and Associates.
Say that again.
Hire Karla Dennis and Associates.
I agree. Hire Karla Dennis and Associates. Here's the key. The best way to make sure that you don't get yourself in a slinky, that you understand the tax plan, that you understand what's going on with this whole Trump tax bill. It's now the law. It's no longer the Trump tax bill. It's now the law, right? Whether we like it, dislike it, it is what it is. So now, the worst thing we could do is put our heads in the sand. The best thing we can do is really get a plan. We need to get informed through strategic planning. We need to get educated, and we need to get a plan. Just like you guys showed up here tonight, you had a plan to come. You got to get a plan. Taxes are not a pleasant conversation, right? Nobody wants to run to their tax person's office like running to the dentist. But the thing that I will say to you is the clients that do plan are the people that pay less tax. So I have a question. Do you think that all of these politicians, this is not a political question, but do you think that all of these politicians that don't pay tax are doing that on purpose, following the law, or do you really think they're tax cheats? How many of you think they're cheats? I'm talking purely on the tax part. They probably cheats on the other part, but purely on the tax part. How many of you think they're cheats? So 2 people. How many of you think they're following the law? Okay. How many of you think they're doing it strategically on purpose? Right. They're following the law. They're doing it strategically on purpose. So on the one hand, we could say, God, they should pay more tax because they make more money. But on the other hand, we could say, we better figure out what they know. Right? So that's my philosophy. We need to figure out what they know. So how do we do that? Step number 1, get organized. If you do not have your records organized, that's the first issue you're going to run into. You got to get yourself organized. We're in the 4th quarter of the game. You guys know I'm a football mom, right? We're in the 4th quarter of the game, and we got to get ourselves organized. Like, you know, the score is like 20-21. Like, who's playing right now? The Dodgers? Did the Dodgers like doing something? What are they doing right now? I'm not a baseball mom, sorry. What are they doing? The World Series? Something going on? Oh. Well, what is it?
They won last night. There's a playoff game tomorrow morning.
Okay, thank you. Yeah. So the Dodgers won last night, right? They got prepared. They got organized. They got themselves together to win that game. It didn't happen by happenstance, okay? So the first thing you guys got to do is get organized. So I'm not going to ask you to raise your hand, but I'm going to give you some tips on how to get organized. Number 1, get you some type of mileage program on your cell phone. Mile IQ is a great mileage program to have on your cell phone. You can put it on your phone as an app. Worst case scenario, you got to get yourself an odometer reading at the beginning of the year and an odometer reading at the end of the year. So you should have gotten an odometer reading in January 2018. You need an odometer reading December 2018. Not January 1st, 2019 for December 2018. You need an odometer reading verified through your car repair place, filling station, gas station. Get a verified odometer reading. Because if you get audited for mileage, you need to be able to prove to IRS how much mileage you had on that vehicle for the whole year. And they're not going to take your word for it. So that's the first thing I will tell you. Get yourself organized.
Is that for self-employed only?
That's for self-employed individuals, people that need to get their mileage reimbursed through their employers. Everybody needs to really kind of track their mileage for a lot of different reasons, but track your mileage, especially if you're self-employed. If you own rental property, track your mileage. Yes?
Is mileage calculated round trip, or is it just to the client's home?
Oh, that's an excellent question. Is mileage calculated round trip? Girl, that's a whole presentation. So let me give you a little bit of a hint as it pertains to that. When you're dealing with mileage, there's a term called what's considered your tax home, like your office, your primary place of business. Okay? If your primary place of business is your home, if that's your principal place of business, and you go from your home to the client, and then you go back, that's tax deductible. If your home is your principal place of business. But if it's not, then that's not tax deductible. So there's a whole set of rules around how to get mileage deducted. As a matter of fact, I just finished up about an hour presentation on that. That's a recorded presentation. That's for a different conversation. But just to answer your question, okay? All right, so where were we?
Good question.
Yes.
So if you have rented properties today, can you assign a car like to take care of those properties, like a truck, let's say, or and just keep that for that?
So your question is, if you have two vehicles, can you allocate one vehicle specifically just for your rental properties?
Yes.
You could do that, but you still got to track the mileage.
Right.
There's no getting around the mileage. Yeah. Okay. So the very first thing I talked about is getting organized, right? That's the very first thing we have to do is find some order in what it is that we're doing. So if you are not tech savvy, if some of you aren't tech savvy, the one thing that I would tell you to do is print your bank statements, print your credit card statements, go through them month by month. Start now. You can start with January. Go through them month by month and start redlining your deductions, things that you think may be tax deductible. Do not wait until January. Do not wait till April 15th. Okay, let's try to get it done now. We could probably get at least 9 months done now, right? So you'll be ahead of the game. So strategy number one is get organized. The very next thing you need to do in order to get a strategic plan is we have to review the past. So let me give you this scenario. Let's say that, and this actually, I don't know if you guys know this, but I'll tell you, it's a perfect story. My son, my third son, because I have 4 sons, my third son that plays college, your eyes open when I said I have 4 sons. Does that surprise you? Because I don't look old enough to have 4 sons, huh? I know. So my third son just had shoulder surgery. Everything's all good, but when we went to see the doctor, the very first thing the doctor asked my son was, did he have any prior shoulder issues? Like, he did his research. He wanted to know, did your son have any prior shoulder issues? Was this the first incident type of thing? So if we're going to do strategic planning with you, the very first thing I want to do is I want to review those past tax returns. I want to see what's good, what's not, what has happened in the past on your tax return. It's important that we get that history under our belts. So it's important that you guys have copies of your tax returns, and we want to see all pages. That's really important for us to understand what has gone on with your taxes so that we understand what it is that you've done in the past. Does that make sense? Okay, so the doctor asked a bazillion questions. What do you think the next thing the doctor did? Who said examine him? Right. The very next thing the doctor did was examine him. The doctor had to assess the current situation, so he examined my son. He made him do some shoulder moves and all of this other stuff so that he could do an examination of his shoulder. We would assess your current situation as it pertains to your taxes. I need to know right now where you sit as it pertains to your tax situation. We are sitting on October, whatever today's date is, right? We have 9.5 months of solid information. For 9.5 months of solid information, we should be able to at least figure out pretty close what your 2018 tax bill is going to be if we don't do anything different. So we should already want to know that number. Why do we want to know that number? Anybody? Wait, do you want to know that number? Maybe that's the question I should be asking, right?
You can extrapolate to what it's going to be at the end of the year.
You got to know the number. Whether you want to know or not, you got to know it. It's sort of like that ugly news where you wait on those test results, right? And you don't want to open that envelope. But the sooner you get the envelope open and you find out the number, the problem, the issue, the faster we can get to a solution. So as the doctor was examining my son's shoulder and having him move, I'm cringing because I can see the pain in my son's face. But I needed for him to do that so we could get to the next step, right? So then the next step becomes what? What do we need to do in order to get him back to where he needs to be? So he asked my son, he said, Cameron, do you want to go out and play football again? Is football going to be done when you exit college? Do you think you're going to go to the league, right? I'm going, he is done with football, man. I don't know what you're talking about, because mama's done. He's like, no, I want to play again. That made a decision for the doctor as to how he was going to correct his shoulder. Whether he should take the time to rehab it or whether he should do surgery to correct it based on what my son's vision was for continuing to play. Does that make sense? So when we are doing strategic planning on your taxes, it's important that I understand your vision. What are you trying to accomplish? Some of you say to me, Karla, I only want to lower my tax bill. And I could get your tax bill low, and you're so happy with me come April, right? And then about 9 months later, when you get to buy that rental property, you call in my office, tell me, where's Karla? You know why? Because I didn't lower your taxes according to your vision, according to your goals and your objectives and what you really want. Because, see, we want a lower tax bill, but we also got these other things that we want to accomplish. So it can't just be about lowering the tax bill. It has to be about lowering the tax bill strategically according to what your vision is. How many of you guys have a plan? Some of you? Nobody in here has a plan? You have a plan? Do you have a plan?
No.
You don't have a plan? We're going to get you a plan. You got a plan? Your plan's your dad's plan? Is that your dad? All right, you're going to plan to do whatever your dad tells you, right? That's your plan. We got to figure out what our plan is. You guys are in here for a reason. You're in here because you want to get educated on taxes. Some of you probably own rental property. If you own businesses, I hope your plan is to make some profit. I hope that's at least a plan, right? You said you were married in here, so maybe your plan is to stay married. I don't know what the rest of you guys over here are doing, but I know you guys got a plan, whether you want to voice it or not. You have some type of plan. And every plan you have, whether it is to retire, whether it is to divorce, whether it is to get your kids out of your house, get them married, get you 4 beautiful daughter-in-laws who are going to take care of you for the rest of your life, whatever your plan is, it's probably going to fall back to your tax return some kind of way. Because whenever money's in motion, money's moving, typically it's going to fall on your tax return. So whatever your plan is, we need to know about it. You should never have your taxes done by somebody that doesn't understand your vision. And you shouldn't have your taxes done by somebody you don't like, right? If you can't talk to the person, what's the purpose? You should be able to do what with that person? Break bread.
Drink a margarita.
Did you say drink a margarita? I'm not going to comment on that because this is a professional business organization. You should be able to drink a margarita with your tax person, right? At the very least, you should be so comfortable with that person you could break bread with them. And if you come in to see Karla Dennis, please stop by Marie Callender's and give me a pumpkin pie because that is my favorite right now. And it's pumpkin season. But that's how comfortable you should be with your tax person. Because if we can't understand what's going on in your world, if you can't really talk to us, we can't really help you. So it's no different than you going in that doctor's office. You got to be prepared to tell us what's going on. And whether you tell us or not, by the time we get done with your tax return and your paperwork, we're going to know anyway. And it's probably not going to be so nice that we had a knew in the beginning what was taking place. You guys follow me? So it's important that we understand your vision. So I challenge all of you in here to get some type of vision or goal going. And you have it. You just haven't put it down on paper yet. But you already have it. That's why you showed up. Now, once we understand your vision, then what can we do? What? Y'all quiet tonight. What's going on? Did you guys have something to drink before you guys got here? You guys are like mellow. Right. You can implement the right strategies. The right strategies, not those strategies you go Google, because you guys know you do that. You guys Google these strategies and then you cut and paste that Google stuff and send it to me and say, Karla, can I do that? I don't know if you can do that because I don't know what your unique situation is. So you don't want to ill-advise anybody. I want to tell you guys the right thing to do, but I want to give you the best advice. If that doctor had said he was going to operate on my son and he hadn't done any clinical tests or hadn't run any tests, I would be a little nervous. Wouldn't you be a little nervous? The first doctor, to back it up a little bit, the only reason why I had to fly to Colorado to get my son's surgery, because the team doctor told me he might probably be able to fix it. He thinks he can fix it. I'm like, wait, what? You think you can fix it? You scaring me. He goes, you know, like how you look at taxes, Karla, like you could probably figure it out. I go, taxes is far different from my son's shoulder. So we're not going to think about it. We're going to be about it, like Nike. So I had to go find the doctor who could get it done. That's what you guys got to do. You guys got to be so intentional about your situation that you find the doctor who could get it done. That's really what it boils down to. Stop Googling for ideas. Stop talking to your friends, because I'm going to tell you that your friends, your neighbors, your brothers, your sisters, they don't have the same tax situation as you. They may tell you they do, but they don't, because taxes are very personable, and unless you guys have shared the same DNA, I doubt it that you guys have the same tax situation. But they're going to always tell you what they do. Karla, my brother doesn't pay tax. Well, your brother probably doesn't make any money either. I'm just being real. That's the real situation. So we got to make certain that we get you guys the right answers and we stop playing with your tax situation. It's a serious business. Once we get it sorted out, then what happens? Once my son had that surgery, we need to follow up, right? The doctor needs to follow up to make sure that he's progressing the way that he should. So he's going to PT, physical therapy, and all the other things that he needs to do. Once we get you to a strategy, we're not done. We got to continue the conversations. We got to show up and we got to make certain what we advise you to do is still the same thing to do. Why is that? Does anybody know why that is? Why should we follow up? Why should you talk to me more than once a year? Because pumpkin only comes out in October through December. So what's the reason? Consistency. What else? Life changes. Life changes. Has your life the same as it was in January? No. Mine is not. I done had a kid, have a surgery, all kind of tricks going on. Life changes. So if your life is changing, do you think your taxes need to be evaluated as your life changes? Let me tell you one of my philosophies. I have a lot of philosophies, right? One of my philosophies is that if you're coming to your tax person brand new, and we don't know you, we don't know your situation, if you're coming to us between January and about February 15th, you probably walk in the emergency room, you're able to check yourself in, you can sit and wait for a while. If you coming in sometime between February 15th, March 15th, someone's probably wheeling you into the emergency room. If you coming in March 15th to April 15th, you coming by way of ambulance, and they doing that shock therapy, okay? That's how it is. If you really want your tax person to help you, you need to be walking in your doctor's office when it's just sort of like a little pain, and you could actually walk in and make your own appointment. But if you're waiting and you're expecting us to pull off a miracle, I want to say that we're good, but we're not magicians. You follow me? We need time to figure it out. And the more time you give yourself, the more runway time, the better off your situation will be. Make sense, guys? All right. So I challenge all of you. We offer complimentary consultations. Some of you have taken us up on them. Some of you have been on the fence. It's there for the taking. Take advantage of it. We will review your situation. At the very least, you will know whether or not you're leaving Uncle Sam a tip. It's up to you, right? When you go out to eat and you get that great service and you get ready to leave that tip, you know how much you're tipping, right? Do you know how much you're tipping Uncle Sam for 2018? No, right? It's a big figure. Trust me, you don't know. So I'm going to park it right there. I'm going to open it up for questions and see if you guys have any questions. But I'm going to tell you, fill out your consultation cards. The team is in the back. They're more than happy to help you answer your questions, whatever the case may be. But before we park it, does anybody have any questions I can answer for them? Yes.
Grandfather property tax. Let's say $9,500 grandfather before the 10,000 threshold. 5 years from now, or this year, it's going to be 11,000. Will it be grandfathered in?
Nope. You're capped at 10,000.
Even though, so the property tax goes up, you're still not grandfathered in?
You're not grandfathered. There's no grandfather provision on that I'm aware of. Now, the question may become, will that 10,000 threshold increase? That's probably what may happen, but there's no grandfathering in on that provision.
So who's grandfathered in on the property tax for that $10,000?
No, so let's make sure we're clear. So if we're talking about property taxes being deducted on the income tax return, nobody's grandfathered in into that provision. Okay, you may be grandfathered in as to maybe your property taxes not going up on the home, but I don't know of any grandfathering in of any property taxes. Bill, are you aware of that?
No.
Yeah, it's
Well, you said something about grandfather.
not for that. Not for that. When I was talking about grandfathered in, I was talking about the mortgage balance. So if you had already had a home prior to December 15th of 2017, and your mortgage balance was over $750,000, you're grandfathered in on that provision, but not as it pertains to property taxes.
Is there a limit on?
Let me make sure we clear his question.
Only the mortgage.
On the mortgage?
Got it.
Okay. All right. Go ahead.
Is there a limit on interest rate that you pay in on mortgage interest?
There's not a limit on the interest. The limit is based on the mortgage balance, on the note balance. So you're only going to be able to deduct the interest up to $750,000 if you got your loan after December 15th. Prior to that, it's $1 million. Okay. Any other questions I can answer? Yes.
Do you have to have or be in a LLC, like an S corp or a C corp, to be able to lease your vehicle to your business, or can you do it as a sole proprietorship?
You don't have to be an S corp or a C corp to lease your car to your business. But my question as a sole proprietorship would be, why would we do that as a sole proprietorship?
Well, if you have if your business is a mobile, you offer mobile service.
But you wouldn't need to necessarily do that as a sole proprietorship. That's not something that you would typically do. The reason why you're going to do it, lease your vehicle to your business as a corp or an LLC, is because a corp or an LLC is a separate taxable entity that requires that the vehicle either be in its name, right? As a sole proprietor, you are the owner. Okay. Any other questions I can answer? Yes.
When you said not getting on the list by either owing or getting a refund, does that increase your risk for an audit or just?
Yes, it does increase your risk for an audit. So let me tell you why I say that. So probably about 3 or 4 years ago, IRS came out with an initiative that said if your tax refund is over $5,000, we have the right to audit. So some people get letters in the mail that says we're still looking at your tax return. So they will print your tax return down and just kind of do a cursory look. Your tax returns may be being audited and you don't even know about it. Okay, they may just be auditing behind the scenes. So you don't want to get a tax refund to give them any reason to scrutinize your tax return. Your threshold should be about $1,000 one way or the other. If your tax refund is over $1,000, it's too high. And if you owe IRS over $1,000, that's too much. You want to stay within that $1,000 threshold. And then the next thing becomes, why would I want IRS to keep my money all year? I don't think our government is very smart when it comes to spending our money. So I don't want them to keep my money. I prefer to keep my own money. And I think that we as business owners need to figure out what we owe the government on a quarterly basis, because we should be paying quarterly taxes and pay them their due. We shouldn't be that far off where we're getting these big refunds. I have some clients getting $40,000 refunds, $13,000 refunds. Like, why are we doing that? I don't see the reason for that. Yes?
Can you comment on the home line of equity, $100,000?
Yes. So when the tax law first, he asked, could I comment on the home equity line of credit? So when the tax law first came out, they said home equity lines of credit were no longer going to be tax deductible. They have since come out with a Treasury regulation saying that it is going to be tax deductible. So you're still good on the $100,000 line of credit for now. I don't know if that's going to change anytime soon, but you're good for now. Yes?
Question. You said that we don't want to receive a lot of refunds, right?
Correct.
You know, what I've been doing, I have a job.
Uh-huh.
What I do, I pay zero.
Okay.
And I figured I will get my money back. Is that the right way to go?
I think it's a way to go. I'm not going to say it's a wrong way to go, but where I would want to challenge you with that is, it's okay to claim zero. It's okay to claim more than that. You should claim the right amount to where you're really not getting a refund. You kind of want to be like at a break even, right? You don't necessarily want to get refunds. I want your mindset to shift and think about, I want to bring my money home on my paycheck. If I'm not going to owe the government, why should I let them hold my money? Some people will say, well, Karla, I use it to pay my property taxes. It's like a savings account for me. IRS is not a bank.
Actually, I do it for that reason.
Yeah.
Saving,
they're not a bank.
Save the whole year.
IRS is a collection agency. They're not a bank. So we need to figure out another vehicle for you to put that money in, strategically.
On federal, you say up to 1,000, it is okay. How about the state?
I would say about 1,000 with the state too. The state of California is more aggressive than IRS. So I'm always going to say you should be within 1,000 on both of those.
So, but if you're sending your voucher every 3 months to the federal, you have to, if you owe more than 1,000, then you have to send to state also?
Yes. Mm-hmm. Both IRS and state of California require estimated tax payments if you owe them. Most of us are used to turning in our 1040 ES vouchers, but you also have the 540 vouchers as well. So if you're going to owe tax to the state, you need to be making those quarterly estimated taxes to the state as well. Yep. Yes.
If you're in a startup phase of,
Yes.
of your business and you have expenses, you've done classes, but you haven't actually made any money, can you still claim those expenses, just expenses of 2018, in the next tax season, if you haven't made money yet?
You want to claim your expenses in the year that you start your business. So there's a thing called startup costs. You can carry over a certain amount. But my question would be, what type of business you have, because the law doesn't say you have to make money to take tax deduction. The law says you have to be in the pursuit of income. So I challenge you to get yourself into the pursuit of income, right? And as long as we're doing all of the things that we need to do to show that we're in the pursuit of income, whether you have a loss or profit, you should be okay as long as you're open to do business and you're doing what normal business people do. Keep your books and records accurate, do all the stuff proper, you'll be good. Okay? Yes?
What if you have a line of credit over 100,000?
Okay, if you have
Is there a grandfather clause?
No, there's no grandfather clause for that. But if you have a line of credit over 100,000, the rule is 100,000 you can kind of do what you want with. Anything above 100,000 needs to go back into improvements of your property, or that money can be used for something else. But you're not going to be able to take a deduction on the interest amount above that unless it goes into improvements of the property.
Well, this was years ago.
Still the law years ago. That's still the law. A lot of people don't realize that, but you only get $100,000 of equity out of your home that you can do other things with. The rest of it has to go back improvements in your home. Yes.
So anything above $100,000, and if you structure into business, like example in stock markets, is that considered deductible?
Well, that's a little bit different story, right? So now we're talking about interest tracing rules. So now you're borrowing money to invest and do something else. That's coming under a whole different type of tax law. And we got to be very careful. So I'm going to tell you guys this other one little component. The other thing we got to be very careful of too, a lot of us do cash out refinances to purchase the next piece of property. You got to be very careful of that because there are interest tracing rules. There's all sorts of issues around that. You have to be very careful. We assume that when you refinance that property, take that money out and go buy that other piece of property, that all that interest is tax deductible. It's not mortgage interest, it's investment interest. So that becomes a whole nother animal. So if you're doing that, you really need to let your tax person know that you're refinancing, cashing out, and buying other property. Because that's a different animal, yes.
What if she's talking about line of credit, if you combine your regular, your primary loan that you had before with the HELOC, the line of credit, refinance it and becomes one loan against the property?
It's not all 100% deductible.
It's not?
Nope. No. And I know that's people think that because the 1098 comes combined and IRS doesn't really challenge that. But I am going to tell you, now that the government, quote unquote, may be getting some less tax, they're going to start challenging more things. Tax laws just changed, so now they got an open avenue. They're going to come down on the mortgage interest calculation. They're going to come down on the meals and entertainment. You will see more audits in that area. That's for sure.
They should add our president first before they add anybody else.
They should what?
I think our president should be first in line for that.
To get audited? I would love to do that audit, man. Right? I'm just saying.
I haven't even had the courage to look at his tax.
Yeah, well, guys, we're going to wrap it up. I am going to ask that you fill out your complimentary consultation cards. Turn those in before you leave. I am Karla Dennis. It is always my pleasure to speak to anybody that wants to talk tax. You guys have a great evening, and I hope that you guys receive some education this evening. Do not forget that we have our KDA educational series the second Tuesday of every month. I know today's Thursday. I'm not that confused. The second Tuesday of every month. I will see you guys next month. I believe it's on November 4th, I think. All right, you guys good? All right. Yes?
Do you want to know if it's better to have capital gains in this year versus next year with the new tax laws that are the same?
Oh, capital gains hasn't changed that much in terms of the new tax laws. So the question really becomes, what's her strategy? What is she trying to accomplish? Her whole goal is probably to lower her income tax, her total tax on the return. So really it's going to be based upon what her overall tax bill